Have you ever wanted to take a massive vacation or a once-in-a-lifetime trip? There are 4 things you need to know financially before you do so. This is Wes Moss, and this video is about a real-life story about the coolest grandmother that we've ever known. We call her Round the World Robyn, and this is a true story. Call into the radio show, and the story goes like this. So Robyn calls in, let's call her in her mid-70s, and she's thinking about taking a trip, a round-the-world trip, one of these, I believe, call it National Geographic. If you look this up, you'll see that they do these round the world trips on a chartered flight where you see 12 of the most magnificent cities and landmarks in the world. Once in a lifetime stuff. It was for her 50th wedding anniversary. And it's a really big price tag though. Think about a trip that costs $200,000. But that's not all. She wanted to take another trip in the same year, and she's planning for it right now. As you may be thinking about taking a big trip. She wanted to go on a safari with her children and her grandchildren. By the way, happy retirees take more vacations, statistically significant more vacations than unhappy retirees. By the way, the number's 2.4 per year. Unhappy retirees take 1.4. So an entire extra vacation per year for the happy retiree group. So I wanted to help Robyn through this dilemma, because there's a big financial implications when it comes to taking a trip this big. The round the world trip is about $200,000 expense, which is massive for a 50th wedding anniversary. The safari, at least $50,000. So we're talking about $250,000 on these 2 vacations coming up next year. Here are the finances. She has about $500,000 in her IRA and about $1 million in her brokerage account. So spoiler alert here, you can't do $250,000 worth of trips if you haven't saved plenty of money and your retirement isn't already, to some extent, prepared for and ready to go. But even for Robyn, who's got that much money saved, call it $1.5 million, $250,000 is a huge chunk and can be financially devastating if you don't do it in the right way. So here are the 4 things that I told Robyn. And her question was, well, how do I pay for this? What's the smartest way to do this for my investments? Well, the first one is, don't tap your retirement accounts, because if you do and you take big chunks out, $50,000, $100,000, $250,000, which she has enough money to do in her retirement accounts, it creates this massive tax bill. It takes your income and it throws it into a really high tax bracket. So then you pay even more tax on all of your income for that year. So you want to avoid your retirement accounts to pay for big expenditures like this at all costs. Instead, number 2, go to your investment accounts. Look at your investment accounts and first of all, look for anything that may not have been doing so well. So you effectively look to sell your losers. That way you don't pay capital gains tax. Let's say you have 20 different investments in your investment account, 3 or 4 of them just haven't done all that well in the last few years and they're flat or maybe slightly negative. If you were to sell those investments, you don't have any sort of capital gain, so you don't have to pay taxes on that sale typically. So that would be the number 2, look for your losers, take out those funds, and again, avoid the potential for taxes. 3, if you don't have any losers, and it's been a good decade for stocks, and if you have a stock account, you might have 20 investments and they all might be positive. Well, you could also look more specifically inside. Let's say you have 1,000 shares of a mutual fund or 1,000 shares of a stock. Well, you might have been reinvesting, which means you have different lots, or you might have bought those shares at different periods of time. So what you would do is you'd look at the lots of the stocks you own, meaning let's say you might have 5 lots. If you have 1,000 shares of something, 5 different lots of 200 shares each. You would choose the lots that have the highest cost basis so that when you sell it, you have the lowest amount of capital gain. Number 4, like we do in a lot of financial planning, if you know you have a specific need coming up over the next 6 months or 12 months or even 18 months, prepare for it today. In this case, my thought to Robyn, or my advice is, since you know you're gonna spend the money, take the money today and put it someplace safe. So you don't have to ride the ups and downs of the stock market for the very capital you're gonna use for this once in a lifetime trip, or once in a lifetime 2 trips in this case. Right now, treasury bonds typically are a very, very safe place to put money, very little fluctuation if you look at shorter term treasury bonds, and you're gonna get anywhere from 1.5% to 2% to 2.5%, depending upon where interest rates are as you watch this video. According to my research, happy retirees take more vacations than unhappy retirees in a statistically significant way. Happy retirees take 2.4 vacations per year relative to unhappy retirees that only take 1.4 vacations per year on average. That's an entire vacation different per year between the two groups. I'd love to hear if you've got any massive or big once-in-a-lifetime trips planned and you're thinking about, hey, how do I pay for it? Our team is happy to help. Comment below or find us at wesmoss.com, WESMOSS.com, contact button, upper right-hand corner. Happy travels.